On today's episode of the Seatrade Maritime Podcast, you'll be hearing from the chief of one of the world's largest offshore vessel companies about how he sees the market and the opportunities that lie ahead. Hi, this is Marcus Hand, editor at Seatrade Maritime News, and we are in conversation with Quintin V, president and CEO of Tidewater. Welcome back to the podcast, Quintin.
Thank you for having me.
Now, you're back in Asia. I think we last met back in May 2024. Maybe just give our listeners a little idea of how your trip out to Asia is going.
Oh, well, I'll tell you, what brought me out here was that we were having a conference in Manila with our mariner populations. A lot of our mariners come from the Philippines. And so we get them together on a regular basis and we talk to them about safety, life on boats. We talk to them about the company, where the company's going, what we can do to work together better. And it's really a lot of fun. Because of the nature of our industry, I don't get to see them a lot. They don't come into the office per se. So the only time I get to see them is if I get on the vessel or if I go to one of these conferences. But between those events, I will send them videos and then talk to them about what's happening with the company or this, that, and the other. And so it's kind of fun because when I see them, it's almost like I know them. Like they feel like they know me, and it's exciting. We take pictures together. And anyway, I enjoy it. But anyway, the trip to Manila is what brought me out to Asia this time.
Oh, I think it's great to get that connection with the crew because, as you say, they are out there at sea. So
yeah, no, it is fun.
No, so you were last on the podcast in May 2024. Perhaps you could bring our listeners up to speed on what's happened with Tidewater since then.
Sure. Well, 24 was an exciting year. So I think, when we were talking in May of 24, we had really started to see the increase in cash flows to the business resulting from the step up in day rates that occurred in 2023. And so 2024 was a really strong year for us from a cash flow perspective. I think we put off about $350 million of free cash flow. And we'll probably do the same this year in 25, another $300 to $400 million of free cash flow, which is quite exciting because there were probably 12 years before that where we were just getting by and the industry was really in a doldrum. But the increase in day rates that happened beginning in 2022, but then in 23 and 24, really stepped up the cash flow generation of the business. And I would say that, of course, we've gone through consolidation to some degree, but we haven't done any since 2023. Still looking, but we've essentially turned to doing share repurchases since then. So we had started it in the very beginning of 24, but we really ramped it up in the latter parts of 24 and then year to date in 25. But that's just because we haven't had other good uses for the cash and we didn't need the cash sitting on the balance sheet. We did a debt refinance earlier in 25. So, when the company was going through its difficult times, when the industry was going through its difficult times, it was hard to get lenders to provide adequate financing for what I see as a cyclical business. But we had gotten to that point by the summer of this year in 25. So one of the things that we did since we spoke last was we reset the debt capital structure of the company. So we took all of the debt and we put it into a long-term unsecured bond in the New York market, which is great because now we have a long-term maturity, doesn't have any real covenants to it. And at the same time, we were able to put in a $250 million revolver, which is just great. We have about $450 million of cash on the balance sheet today from the cash that we've been generating over the last couple of years. But just having that revolver there gives us added financial flexibility. So I'd say in summary, since the last time we met in 24, it's been a little bit of just business as usual, blocking and tackling, making sure the business is performing, generating cash, and then a little bit of balance sheet reorganization.
If you're enjoying the Seatrade Maritime podcast, make sure you never miss an episode by subscribing on the app of your choice. It sounds overall like it's a much more comfortable financial situation than it was a few years ago then.
Absolutely. And I'm so happy to be in this position, honestly. But, we know that this is a cyclical business, and it's a business with a high degree of operating leverage. And so when you see the day rates come up as they have, it's exciting because the operating cash flows grow exponentially. But we're also very cognizant that that can reverse. And through a cyclical industry, we're going to see times like that. I actually don't see it in the next 2 to 3 years, but we have to build the business so that we're resilient to that when it occurs.
So you're actually reasonably confident about the outlook going forward then?
I am reasonably confident. There's the couple of things make me real confident about the industry. One is there's been a change, and maybe it started about the same time that we spoke last in 24, but there's been a growing acceptance around the world that as much as the world wants to move away from hydrocarbons, it can't, and it can't as fast as it wants to. And as a result, there's still a lot more drilling and production activities that need to occur over the next couple of decades in order to satisfy the global requirements for energy. And it's become acceptable to say that. Even 4 and 5 years ago, people didn't really like that commentary. And so as a result, you're starting to see people make large investments in offshore fields. So Brazil's been very active. The Southern Caribbean has been very active. And even Saudi Arabia and OPEC has really begun to lean back into production-oriented long-term activities and investments.
And you see the company is sort of well-placed to meet that demand?
I do. The nice thing about the situation that is in our industry today, so because of the difficulties that we saw in 2014 to 2019 timeframe, and then even through the pandemic, people haven't invested a lot in our industry. So there haven't been a lot of vessels ordered. Recently, there's been some. But as a result, the industry is generally undersupplied in the number of vessels necessary to meet that growth requirement that I was just referring to. And so that puts boat owners in a great position. It's a position that we're not often in, which is to push day rates up to what I would say is an acceptable level. And we're not even there yet at an acceptable level. But it pushes us up to a point where we're making cash flow and we're being able to return money to shareholders or make proper investments.
You mentioned there, you said day rates are not up to what you'd see as an acceptable level. Where would that be?
Based on the construction cost today, which is depending on where you're going to build. You build in China, that's probably $45 million. You build in Brazil, it's probably closer to $85 million. Northern Europe, probably in that $70 million range. And most of the building right now is in Brazil and in China. And for those lower numbers, like the build cost in China, you need about $30,000 a day for 20 years at about 85 to 90% utilization in order to make your cost of capital, which I would call in the low teens. So, and today we're currently printing day rates that are $22,000 to $23,000 a day. So there's still, to me, a real step up that's required before I would say, okay, yeah, this makes sense.
All right. So you're not about to join those who've been ordering new buildings then?
No, I'm not. It's very natural in the shipping industry to speculate, right? And of course, if I were to make a delivery today, that means that it probably wouldn't get delivered until 2027. And so I have to forecast, okay, what market am I going to be in 2027? And it's still a stretch to go from where we're at today to $30,000 a day in 27. It could get there. In 23 and in 24, we were able to push day rates up about $4,000 a day. So, but those were really strong years. Drilling had a real resurgence as well as subsea activity, and it really put a strain on vessel supply. And there were some vessels on the sidelines that were inactive and needed time to become active and investment to become active. And so, as a result, we're able to push day rates up nicely. But for example, in 2025, when the market has been just about the same as it was in 24, we've been able to push day rates up maybe about $1,000 a day, $1,500 a day. So to get to $30,000 a day, I need a little bit more offshore activity and strengthening to get there. So,
do you see that activity coming?
I do. It's a lot of it right now depends on the drilling activity and the drillers. And what we saw in 24 and the first part of 25 was a lot of exploratory related drilling, in various areas off the coast of Africa, but even in areas in South America. And I think what we're going to see, and it's starting to develop in the second half of 26, is a lot more development drilling. To go back into those areas and to refine the field plans and so forth. And as a result, I see that activity picking up. And I'm already starting to see it getting scheduled by the drillers. So I watch that real closely, drilling activity and the backlog that they're developing for the second half of 26, because it looks like it's going to put the industry back on a course of relative tightness in favor of vessel owners and rig owners.
After such a long downturn, I'm sure that's a very welcome position to be looking at.
It is. I like these times better, but I have to always remind myself and position the company to be resilient, whatever happens. But it's nice. Yeah.
Understood. And obviously, being resilient, especially in the sort of markets we're in these days, is very important.
Yes. Yeah.
Now, coming back to the other piece, I think that Tidewater is very well known for. You touched on it briefly earlier, which is consolidation. You acquired quite a number of companies,
yes,
fairly quickly. Is that process all now complete and everything integrated?
No, it's not actually. I've been real focused on opportunities in the Americas. So North America being primarily the U.S. Gulf of Mexico, or Gulf of America, as they tend to refer to it as today, and Brazil. And we're seeing real strong developments throughout the northern part of South America. So this is Suriname, Guyana, Trinidad, which is a strong legacy oil and gas operating area. But all of that looks really good for the next decade. And so I've been trying to find vessels that would fit that geography. And there are some, for sure. In fact, there's I could think of probably 70 or 80, of vessels that are out there. But I need to get them at the right price. In our industry, the entry price is very important because you could really destroy value by overpaying for vessels, or getting the wrong vessels, or getting vessels that are in poor condition. So we spend a lot of due diligence money on trying to find the right vessels and get them at the right price. And so I've been focused mostly in the Americas. I'd like to get something done, but nothing's really come to fruition just yet. But I'm not adverse to doing acquisitions in other areas of the world either, because it's really the boat type. I really just need an international class, large PSV and large anchor handler. I can get those in other geographies of the world too. I just got to manage the relocation costs and things like that.
Right. So it's not actually that geographically specific per se.
No, there's a couple of things, though, that are unique about the Americas that I'd tell you about. One is in the U.S., we have very strong protectionism laws, and it's referred to as the Jones Act. So if I want to for the U.S. market, then I definitely have to buy something in the U.S. All right. And Brazil has a real strong preference and a real advantage of having Brazilian-owned tonnage. So there are other geographies around the world, but those two in particular are very stringent. And so in order to be successful in those markets, you really have to buy in. But you can do a little bit of both, and so I look for the opportunities to prevail and finding some great boats at the right price. And what tends to happen in our industry, just as we were alluding to earlier about people building vessels when the market begins its upturn, they tend to accelerate and increase their price expectations for vessels. And it's very natural. But I have to take a through the cycle view. And very often sellers don't want to take that view. They want to take the spot market or the very optimistic view. And that's okay too. But we just got to find some middle ground. And I think that'll happen. And sometimes when we have these ebbs and flows in the industry, it makes those negotiations a little bit more practical.
Yeah, that was what I was going to ask, because you've given quite an upbeat view on the market yourself. Yeah. Surely that drives prices upwards.
I know I have to be careful, right? But it is true, but here's how I would think about it, right? So when, we were talking about the fact that, in order to earn its cost of capital, a reasonable vessel built today would take $30,000 a day. And we're not quite there yet. So that when I'm pricing vessels on the secondary market, I need to factor that in. And very often people that I'm trying to buy from have already factored in the $30,000 and are looking to, even top that. And we may get to that point, but that might be 3 or 4 years from now. And there may be some intervening ebbs and flows. I get surprised sometimes, as logical as this market can be. And I know the guys on the vessels will crucify me for saying this, but this is a simple industry. It's not simple to operate a boat, but the industry is quite simple. But I do get surprised sometimes when supply and demand factors don't dominate the day. And a case in point, I think, would be the UK sector of the North Sea. It's been it's been a bit of a dog's breakfast the last year and a half. And it stemmed from the fact that the governing authorities in the UK have put in tax disincentives for oil and gas operators. And I think that they may come to realize that is a mistake, because I think that they're isolating themselves from a real advantage that they have to be energy self-sufficient and so forth. But nonetheless, it has resulted in a decrease in activity for our type of vessel in that market. And I find it quite surprising. But I'm able to relocate the boats fairly easily. I can relocate them to Norway. I can bring them into Brazil on a tag-along basis, or back down into Australia, or in some areas of the Mediterranean, West Africa too. But anytime there's an excess supply of boats, there's a lull in the ability to continue to push day rates, because those boats have to get absorbed in other geographies. And so sometimes I get surprised by those things. And I try to talk to my counterparties when I'm acquiring vessels. I'm like, we don't know when these things are going to happen. I can't build in a perfect scenario, so I need to build in a discount on the price of these boats so that I can make sure that my shareholders get an appropriate rate of return. And as logical as that is, they don't really like to see it that way, and I understand. But I'm patient, and I can always repurchase shares and create value for my shareholders that way. But longer term, I'm looking for opportunities to expand the fleet and expand the geographic reach of the company.
Yeah, because I was going to say, you've said not ordering new buildings, and you're currently not finding the right acquisitions or the right price on those acquisitions, shall we say. Your shareholders will still be looking for growth, won't they?
Yes, they will. And so, yeah, and they certainly don't want me sitting around with $500 million on the balance sheet, even though interest rates today are better than they were 3 or 4 years ago. That's still, minuscule compared to the returns on the vessel industry. So reinvesting those monies by repurchasing shares, or some strategic one-off acquisitions as well can be advantageous.
When you say strategic one-off acquisitions, what do you mean?
Well, there's a couple of opportunities that we picked up boats for, but it's like a 1 or 2 boat purchase, which is, you're not going to get a boat when you're. Well, let me step back and say, when you acquire a fleet, you're always acquiring some cats and dogs, and you're always acquiring some vessels that, perhaps aren't as in enough shape, the best of shape. And you can use that to your advantage by solving a problem for a seller by taking a fleet of vessels and then disposing the ones that you don't want longer term. And so you can get the whole lot at a better price. But if I go off and I buy one vessel in Asia or a couple of vessels in China, then I generally have to pay more close to prevailing full price on the boat. So they're good deals, and I can use them for particular contracts that I have. But it's not as ideal as buying an entire fleet, and it doesn't really move the needle for my shareholders as quickly.
Yeah. So, but you do look at those sort of one-off, sort of second-hand type acquisitions.
Yes.
Yeah. Okay. I say they're a pretty positive sort of outlook you've given overall. Where do you see the market headed over the next, say, 12 months?
Well, I'm really excited to see where the market's going to go over the next 12 months. There's a lot of talk in the industry about improving fundamentals through much of 26 and into 27. And it results from what I alluded to earlier, which is the fact that we have underinvested in oil and gas for so long that we've got to catch up, and we've got to find new sources of production capacity for oil and gas. In the near term, though, we're competing with the fact that Saudi Arabia and OPEC broadly are releasing barrels into the market. They have been very disciplined and have been withholding capacity from the market through really beginning through the pandemic era and through now, although through much of the last 12 months, they've been releasing incrementally more barrels into the market. So we're in this unique situation where the oil price is good, but probably not as good as a lot of operators would want to see before they make a significant investment in offshore activity. But they know that the price is currently weighed down by the fact that Saudi Aramco is releasing additional barrels into the market, and that there's upward pressure on oil prices that is being subdued by that release of barrels by OPEC plus. And so they're gauging the momentum with which they jump into the market. And so over the next 12 months, I think we're going to see that play out, where you'll see continual release of barrels by OPEC plus into the market absorbing those, and then the majors and super majors leaning into particular geographies that they think that will provide a long-term advantage to them.
Great. If you look at that sort of outlook, what would you see as the top 3 opportunities for the offshore vessel sector?
It's going to be really interesting. So it varies by geography, and it somewhat varies by sector. So, one thing that we saw leading in and up to 24, so like 22 to 24, was an increase in activity in the United States market related to offshore wind. But the current administration in the U.S. has been against developing offshore wind. And so that activity has been very soft. And as a result, it's put pressure on the oil and gas sector in that particular market. But my belief is that we're going to see that pick up in the next 3 to 5 years. So in the next 3 to 5 years, I think you'll see that come back. So offshore wind development in the U.S. Gulf of Mexico, it needs to find its economic footing. And I think that it will. And then as a result, we'll see that pick up. Around the world, one of the more interesting developments has been the continued focus on subsea activity. So, most of the activity for future development of oil and gas activities goes to the subsea market. And it can be a very vessel-intensive market depending on where you're at. So things related to subsea and things related to FPSOs in particular, I think are going to be very strong over the next 12 months as well as in the next 2 to 3 years. The FPSO market, which is becoming the de facto standard in South America, I think is going to be very strong. Areas like offshore Guyana, but also Brazil, be strong FPSO markets. And as a result, vessel activity adjacent to FPSOs will increase over the next year to 2 years. if we see a settling down of geopolitical hostilities in the Mediterranean, as well as throughout the world, honestly, but particularly I'm thinking about the Ukraine market, we may see an increase in pipeline activity and pipeline repair. And that would be certainly vessel intensive, and so that may pick up. So there's a bit of a peace dividend that could occur if we see some of the geopolitical unrest settling, both in the Mediterranean as well as in other areas in the world.
Hopefully that does happen.
Yes, indeed.
It would be really interesting to watch how those developments play out. Now, I'm just going to kind of wrap this up. If we come back and meet for the podcast in 18 months' time, where would you expect Tidewater to be? Where would you like to see the company?
Well, I hope that when we meet 18 months from now, that I'll be able to demonstrate to you that we put the cash that we've been generated to good use. So we found some value accretive acquisitions for our shareholders. We've expanded the geographic reach. So we've improved the age class of the vessels, which means we've reduced the overall age of the fleet, even though we've aged another 18 months. And and maybe even some more exciting things to discuss about the future of the industry and where it's going.
Fantastic. Look forward to talking to you again. And Quintin, thank you so much for taking the time to talk to our listeners today.
Oh, thank you.
Thank you for listening to the Seatrade Maritime podcast, and we look forward to joining you on our next episode.